Hi, welcome to Truth Points, lifting the media veil, revealing the facts. Today we'll explore Truth Point 105, the war for your cash. We'll look at the questions about banks, digital currency and cash, and new laws that are trying to distance you from your money. We'll look at this topic and together discover the truth. I'm Mark. Thanks for tuning in to Truth Points. Hi, this is Mark. Thanks for coming back and listening to Truth Points. This is Truth Point number 105, the war for your cash. That kind of has a nice ring to it if you say it a few times. War for your cash. But make no mistake, banks view your cash, and perhaps even you, as the enemy. Your cash might stand between them and their next fix. You and your cash are effectively the concerned family intervention on their profit addiction behavior, and they're digging in for a fight, wrestling control away from you. In today's Truth Point, we examine the reasons why banks are doubling down on eliminating cash, and just as important, we'll explore what you can do to protect yourselves and your assets in the wake of this trend. It's Truth Point number 105A, Chapter 1, Banks as Political Beneficiaries. The first idea we need to discuss is that banks have evolved into creatures that don't resemble their predecessors in past generations. Each of us has a mental picture of what a bank should be related to trust and honesty and integrity and solidity, but this image has evolved over generations. And there's a good chance that your concept of banks and banking came from your parents or grandparents, just like mine. Such is the way that we learn about money and how things are around us. Banking has changed, however. It's evolved into drunk partygoers instead of conservative teetotaling bow-tied chaperones. The problem for us is that banks have not changed their name to fit their changing standing. First Trust Bank isn't suddenly renamed Risk Bet Merger and Wager. So read or listen to this post just to say that you can stay abreast of changes in the industry. And as always, do your own thinking and see where you personally weigh in on these issues. As an aside and disclaimer, these are my opinions, and these ideas apply more to the top 5 or 6 mega banks than they probably do to your local credit union. I would argue that the Federal Reserve, which is privately conceived by bankers on Jekyll Island, Georgia in 1910, is a privately held banking cartel. I presume that it's common knowledge that the banker-owned Federal Reserve, as the quote says, as Federal Express, and it's not an arm or agency of the U.S. government. For more information on this topic, I would send you to read the 1994 book by G. Edward Griffin called The Creature from Jekyll Island. The Fed, as they call it, is interlaced with the government, however, in contractually printing our currency debt, Federal Reserve notes. And as such, it's uniquely positioned to outwardly stabilize the U.S. economy through currency creation and setting interest rates. Inwardly, however, it has the incentive, as does any cartel, of promoting the interests of its member banks and the banking industry in general. Outwardly, everything they do is for the people, the common good, the country, and for you and me and jobs and motherhood. But inwardly, their decisions are motivated to serve the banking industry. That's what cartels and lobbyists do, and we ought to be clear on that. In this way, banks benefit from riding the financial waves created by the actions of the Federal Reserve, and they also benefit from policy dictated by this central bank, such as the 2008 idea of bailouts for banks that are deemed too big to fail. Every company or industry, by necessity, feels that they are important, but the banking cartel insisting that their members are more important than the aggregate self-worth of U.S. citizens is a bit much. Ask the people in Iceland who, when faced with a similar bailout proposal, said no, and they threw the bankers in jail. After a year of recovery, they are doing just fine without the bailout. In the U.S., the 2008 TARP bailout money amounted to an $800 billion cash infusion for Wall Street and bank balance sheets. It rescued them from banking losses and that they earned gambling in the highly speculative derivatives and subprime mortgage lending business, which, by the way, were rated and established to be risky by definition. $800 billion, by the way, was an amount equal to all the cash in circulation at the time, effectively doubling the currency supply, or more accurately, diluting the value of U.S. currency through inflation in half. Like an impulsive, impetuous teenager with $10 burning a hole in his pocket on a mission to spend, banks found themselves currency heavy and with an unlimited credit line at near 0%. In this way, banks became beneficiaries of the Fed policy and of political and economic circumstance. So, banks changed their character. There was free money to invest, profits they didn't want to leave on the table, even if it was officially outside of their chartered activities. I've met a few people whose lives were changed by fate and fortune, maybe a lottery windfall or an unexpected inheritance. At first, these people reaffirmed to friends and family that money won't change them. But the potential of a newfound windfall is like a siren call to the indulgent senses, an addictive drug luring the user to seek ever more profit, leaving logic and restraint aside. No longer content to earn money the old-fashioned way on small stuff like interest margins, banks yearn for the easy big money payouts of the speculative futures and derivatives market. And frankly, why wouldn't they? If I let you loose in a casino with a bag full of markers and the assurance that you could keep your winnings, but the taxpayers would cover your losses, why not gamble and let down your guard, do a little partying, put aside your inner accountant conscience, and live a little? Magnify this initial $800 billion 208 infusion with the 3 subsequent rounds of Fed quantitative easing money printing that totaled $3.2 trillion. And you can see how well stocked the punch bowl is at that particular industry party. The one thing that I've never witnessed with addicts or people entrenched in delusional spending is what I would call self-limiting behavior. Casinos know this. Comp the room, throw in some free liquor, free food, pump in some oxygen, pump up the music and bright flashing lights, the taste of free money, and people stay at the tables. There's no reason to leave the fun. Our painful bailout in 2008 solved the problem, but the costly infusion from us never had any strings attached for them to close down the lifestyle and party mentality that the bankers on Wall Street had embraced as normal. The bailout was an infusion of drugs and a payoff of drug debt, not an intervention. So the party continued, and it actually revved up. Bottom line, we never solved the source problem behind the 2008 crisis. The Fed turned on the printing presses and gave $3 trillion to their bank agents to distribute the windfall into the economy. Except, in the fog of the party, they didn't do such an equitable job. It seems that bank bonuses went up to the sky and bank profits and assets rose. But I never did meet anyone on Main Street that received any of that boom trickle-down money the Keynesian economics promises when money is introduced at the top of the funnel. I personally think that $800 billion could have been better spent bailing out tens of millions of upside-down mortgage holders instead of the lenders. Then again, maybe I just live in the wrong small town. But I suspect that the party stayed on Wall Street. Bottom line, though, banks got a taste of living high, and the thought of trading down and leaving the dream didn't sit well with them. Unlike a professional gambler who knows when to hold and when to fold, banks are still drinking in the after-party spiked Kool-Aid. Sunrise will come, the party will end, but they're eagerly waiting for the last call at the Titanic bar. In barely over one generation, the government and the Fed turned one of the most conservative industries into greedy street criminals who will do or say anything to worship their newfound addiction to profit. Truth Point 105B, Chapter 2, Sleight of Hand in the Digital World. We discussed that the banks feel safest speculating when someone else will rescue them. Who wouldn't? After 2008, it became clear and unlikely that taxpayers would not be excited about a second round of bailouts. First time, shame on you. Second time, shame on me, my dad used to say. So they cooked up a crafty safety net that involves using your money and my money to offset their gambling losses. The banks test drove this in Cyprus when it looked like they were going to take a big hit. They called it recapitalization, but we can call it a bail-in. Even simpler, it means using depositors' segregated money to bail out bank losses. You can see that recapitalization is a far more politically correct phrase than stealing customers' money. This seems preposterous and beyond possible, doesn't it? Well, I direct you towards our truth point number 103. Are your savings safe in the bank? People who are drunk and addicted and desperate think of some pretty wacky things. And the world that they're living in isn't rational. So there are equally irrational justifications to explain it to us. The sad part is we don't stand up to them. Go ahead, hit me. Hit me again. Well, maybe it'll feel good when they stop. Along the way, while we were worried about Ferguson in the news, they passed laws in the last-minute December omnibus bill that kept the country's economy on life support for another season. And it also pledged our deposits as collateral if banks should need help from their gambling losses. So there, it's already in place. And the G20 leaders all around the world endorsed it too, in case you thought that banks didn't have a chokehold on other world governments. So what's the risk? The top 4 U.S. banks have about $1 trillion in deposits each, and I'm generalizing. They also each have from $25 to $50 trillion each in derivatives and speculation exposure. To put that into perspective, which is next to impossible, remember that the annual GDP, the work output in the U.S., is about $17 trillion, and the GDP of the world is about $60 trillion. So the 220 plus trillion that banks have at risk is troublesome. Our paltry $8 trillion of consumer funds on deposit won't make much of a bailout dent if one of these banks goes belly up, but it is enough to give a last round of bonuses and to pay off cronies and friends. Truth Point 105C, Chapter 3, Why Cash Matters. Bankers are drunk, addicted to profits, and they don't sleep much because they're partying. But if they did, there are 2 things that might keep them awake at night. The first is a consumer run on the bank's vault cash. The vault cash is a symbolic gesture of physical cash on hand, a leftover from days gone by. And vault cash today is probably at about the 2 to 3% of deposits level. The second is that cash is nearly impossible to control. While digital numbers money is easy to seize, hold, manipulate, and control, dreaming bankers prefer total control without the messy bother of rogue cash. No one knows exactly what may happen or when, but we can project a scenario by dragging out some of the bank's old playbooks. The dress rehearsal for unbridled leveraged debt investing gone sour was a company called Long-Term Capital Management, a Greenwich, Connecticut hedge fund run profitably for 4 years using advanced computer models to invest. By 1998, though, they had equity of only 3%, and the bond market suddenly turned, leaving them exposed for over $4 billion. Private deals with investment banks bailed them out, averting a catastrophic financial disaster. You've probably heard of investment advisor Jim Rickards, who was part of the legal team that brokered the bailout deal. But here's the point. You and I never heard about the deal, let alone the problem, until it was over. When these financial meltdown things happen, they aren't in the news. They're addressed quietly. You won't get advance warning to withdraw cash on the Morning Drive News or on Facebook. You'll get the notice that your account has already been frozen, though. Our financial meltdown of Bear Stearns and AIG in 2008 also reached critical mass in private, until the banks and the Federal Reserve privately concocted a bailout plan, putting the weight of the Wall Street gambling losses on the shoulders of the American taxpayer for $800 billion. Lobbyists and Fed spokespersons pushing this through Congress in just a few days were quoted telling congressmen that the United States would experience martial law and a 75% drop on Wall Street if this bill was not passed. Again, the problem never came to the surface until the bankers had a solution to sell us. We, the public, are not privy to such bad news, and the solutions are always rush, rush, rush. Somehow, they usually involve reaching in our pocket for money, too. Ex-Goldman Sachs chair John Corzine lost over $1 billion in his company, and on reported threats of death by his creditors, he chose to bail in his depositors' supposedly segregated funds as his company, MF Global, hit the skids. When Cyprus was unable to pay its debt obligations to the European Central Bank, they demanded a bail-in. On Friday, everything was normal. Over the weekend, there was a bank holiday, which froze all accounts and even ATM withdrawals. By Monday, depositors found that they had taken a 30% haircut with their funds on deposit. Again, these problematic crisis solutions do not historically come with any warning to the public. Banks act for their own interest, in stealth, taking depositors by surprise for maximum control and profit. For this reason, you can easily see that you or I are not nearly high up enough in the food chain to have advanced knowledge of these crisis events. We discussed in Truth Point number 103 that the FDIC has only 3 cents insurance for every $100 on deposit, and that banks can legally create loans up to 90% of funds on deposit. Furthermore, since we've been so compliant in embracing digital statements, digital transfers, and using the convenience of plastic, banks rarely keep more than 1% of deposits in physical cash. Estimates vary, but many feel that there is only physical cash to cover about 3% of deposits. Just don't cut in front of your neighbor to withdraw money. It's not polite. Wait patiently in line like the Greeks did, hoping that there was still money in the ATMs when the banks closed for 2 weeks. So that leaves us in a digital world where 97% of what we do happens on computers or smartphones or even inside ATMs. We saw in Greece in July 2015 that banks can close for a week or two and that ATMs can be severely limited or just plain out of cash. My point here is that numbers on a screen are not money in hand. A computer program or an electrical outage can severely distance you from your currency numbers. You might be comforted by knowing that it's there, safe in cyberspace somewhere, but the gas station owner may not be interested in your frozen plastic card account, even if you bring him your bank statement. And you probably won't get too many groceries or water at the supermarket clean-out with a promise to pay later when the lights do come back on. Ask people in Greece who were forced to live on about $70 a day in ATM withdrawals if they should have withdrawn some cold, hard physical cash before the bank closures. You know the answer. A word to the wise. So, banks hate cash. It's a nuisance. And since banker gamblers are feeling their machismo, they're craving control. Like it or not, we need to face up to the fact that numbers on a screen are in their control, and cash in your hand is out of their control. They don't pay interest anymore, and most banks, especially the large ones, are running up huge gambling debts that one day soon will come crashing down on them, and probably you and me. So let's be smart people and withdraw our cash, or at least some of it, from the digital grips of people with a big gambling problem and their own interests in mind. You're perfectly capable of managing a few hundred or a few $1,000s in cash on your own, and I suggest doing that, maybe gradually, but soon. And there's an added benefit. You won't believe how well you sleep, knowing that you can actually touch your money and that there's nothing between you and your currency. Let's be smart and not participate in the inevitable flurry of stress that will accompany impending bank failures and closures and ATM limits from the greedy gambling habits left over from the 2008 non-recovery. Every family in America lost thousands in that bailout. First time, shame on you. Second time, shame on me. Be a role model for responsible banking to your friends and to your family. Be the trust you want your bank to be. Hold your own cash. This is Mark. Thanks for listening to Truth Points.